You start a small business selling products online. No paperwork, no forms, nothing filed anywhere. Technically, you're already running a business right now, whether you meant to or not. That default setup has a name, a sole proprietorship, and it comes with one massive risk almost nobody explains clearly. If your business gets sued or racks up debt it can't pay, your personal stuff, your car, your savings, even your house, can be on the line. By the end of this video, you'll know exactly how an LLC actually protects you, where that protection quietly breaks down, and which structure genuinely fits your situation. Let's start with the default setup, because most people are already in it without realizing. The moment you start doing business under your own name, without filing anything, you're automatically a sole proprietor. No paperwork, no registration, no separate entity. Legally, you and the business are the exact same thing. That simplicity is appealing. There's nothing to set up, and taxes flow straight onto your personal return. But that same simplicity is exactly what creates the risk we need to talk about next. Here's the part that surprises almost everyone the first time they hear it clearly. As a sole proprietor, there is zero legal separation between you and your business. If your business gets sued, a client claims you damaged their property, a customer gets hurt using your product, you personally are the one being sued, not some separate entity. That means a judgment against your business can come after your personal bank account, your car, and in serious cases, your house. Business debt works the same way. If the business can't pay a supplier or a loan, creditors can pursue your personal assets directly. This is the exact problem an LLC is designed to solve. An LLC, or limited liability company, creates a legal separation between you and the business. Once formed correctly, the LLC becomes its own legal entity. It can be sued, it can owe debt, and in most cases, that stops at the business rather than reaching your personal assets. This is called the liability shield, and it's the entire reason LLCs exist as a business structure. Forming one usually means filing paperwork with your state, called Articles of Organization, along with a filing fee. You'll also typically need an operating agreement, even as a single owner, outlining how the business is run. On paper, this sounds like it solves everything. In practice, there's a catch a lot of new business owners don't find out about until it's too late. Here's where it gets interesting, and where a lot of people lose the exact protection they thought they had. Courts can pierce the corporate veil, which is a legal way of saying they can ignore your LLC's protection entirely under the right circumstances. This usually happens when someone treats the LLC as just an extension of themselves instead of a separate entity. The single most common cause: mixing personal and business money in the same bank account, called commingling funds. If a court sees personal and business finances tangled together with no clear separation, they can decide the LLC was never really separate to begin with. Other triggers include failing to maintain required paperwork, undercapitalizing the business intentionally, or personally guaranteeing a business loan without realizing what that means. Let's talk about what forming and maintaining an LLC actually costs, because this varies a lot more than people expect. In California, LLCs pay an annual franchise tax of $800, regardless of whether the business made money that year. In Texas, there's no state income tax, but LLCs may owe a franchise tax depending on revenue. In states like Wyoming and Nevada, annual fees are much lower, which is why some business owners form LLCs there specifically, though that comes with its own complications if you don't actually operate in that state. On top of state fees, most LLCs need a registered agent, ongoing annual report filings, and separate business banking, all real costs and real paperwork. A sole proprietorship has essentially none of this, which is exactly the trade-off you're weighing. More protection, more paperwork and cost. Less protection, more simplicity. Neither one is automatically the right answer. Now here's a mistake that has genuinely cost real business owners thousands of dollars, and it happens constantly. Forming an LLC and then never treating it like a separate business. Using the business bank account to pay personal bills. Paying yourself irregularly with no clear structure. Never actually signing the operating agreement. Each of these chips away at the legal separation the LLC is supposed to provide. The fix is simple in concept, even if it takes discipline. Separate bank account, separate bookkeeping, and treat the LLC as its own entity in every financial decision. An LLC isn't a magic shield you file once and forget about. It's a structure you have to actually maintain. Let's quickly cover taxes, because this is where another common myth comes in. Both a sole proprietorship and a standard single-member LLC are taxed the same way by default. Profits pass through directly to your personal tax return. Forming an LLC by itself does not automatically change your tax bill. Where taxes can change is if you elect to have your LLC taxed as an S corporation, which is a separate decision from forming the LLC itself. An S corp election can reduce self-employment tax for some businesses, but it adds payroll requirements and complexity. Genuinely worth a conversation with an accountant, not a decision to make from a YouTube video alone. One more thing almost nobody explains clearly. An LLC and business insurance are not the same protection, and one doesn't replace the other. An LLC protects your personal assets if the business itself is sued or owes debt. Insurance covers specific claims, an accident, an injury, property damage, often paying legal costs and settlements directly, sometimes before the LLC's protection is even relevant. Many small businesses genuinely need both, not one instead of the other. So which one should you actually pick? Let's break it down by real scenario. If you're freelancing with low physical risk, writing, design, consulting, a sole proprietorship might be genuinely fine to start, especially paired with a solid insurance policy. If you're doing anything with meaningful liability exposure, contracting work, anything involving physical products, client property, or vehicles, an LLC starts making a lot more sense. If you own rental property, especially more than one, many landlords use a separate LLC specifically to isolate liability, property by property. If you're bringing on a business partner, an LLC also creates much clearer legal structure for ownership and decision-making than an informal partnership does. There's no single right answer. It depends on your actual risk exposure, not just what sounds more official. Quick example. A freelance graphic designer working from home has relatively low risk. A sole proprietorship might be reasonable, especially early on. A contractor doing home renovations has significant physical risk. A single accident on a job site could be financially catastrophic without an LLC and insurance both in place. A landlord with 3 rental properties often uses 3 separate LLCs, so a lawsuit tied to one property can't reach the other 2. Same basic decision. 3 completely different right answers, based entirely on actual risk. Let's cover a few quick follow-up questions. Can I switch from a sole proprietorship to an LLC later? Yes, this is extremely common. Plenty of businesses start as a sole proprietorship and convert once risk or revenue grows. Does forming an LLC protect me from my own mistakes? No. You're still personally liable for your own negligence or wrongdoing, even inside an LLC. The shield protects against the business's general liabilities, not your own direct actions. Do I need a lawyer to form an LLC? Not always. Many states let you file directly, though a lawyer or accountant is worth it once your situation gets more complex. Is an LLC worth it for a very small side business? Depends entirely on your risk exposure and how much you're already earning. Worth weighing the annual cost against what you're actually protecting. So here's the real takeaway. A sole proprietorship is simple, but leaves your personal assets exposed. An LLC adds a real liability shield, but only if you actually maintain it properly. Neither one is automatically better. It depends on your specific risk, your industry, and how disciplined you'll actually be about keeping things separate. One last thing. I'm not a lawyer or an accountant, and this stuff really does change from state to state. So before you file anything, run your specific situation by someone who actually knows your local rules. If this helped you think through your own business a little more clearly, that's exactly what this channel's for. See you in the next one.